MTN SME Hub. Link to growth. Link to success. Link to the ultimate resource for business advice and insights.
Welcome back to the Big Small Business Show. In studio with us today, we've had Simone and Jonathan Penn, and we've been talking about Smell Mai Pits. This is a deodorant, the natural deodorant that is selling between 1,000 and 2,000 units a month. And the question today is this dilemma about increasing turnover, but then that will affect liquidity. So when I was asking you about stock, I was obviously asking you, well, is part of your liquidity going into stock that you're holding more and more stock as you're growing? Where I would start to focus on is not the ROAS, but the customer acquisition cost. And so the whole idea of understanding your customer acquisition cost in totality versus the lifetime value at a GP level. Okay, that is the question more than the ROAS, because the advertising spend is but one thing. There's your time. That is your time. There's a whole bunch of other considerations in terms of that cost. Now, you know, the question for me is that, do you take on more an OD facility, an overdraft facility, or do you take on an investor? You alluded to that. They both have got positive and negative. If you have a strategic investor who can help you grow, well, then that's a positive thing. But very often people say that they're strategic and they're not strategic. So what does strategic mean for you? If it's market access, well, that's why I asked you about B2C, because B2C is not market access. If it's about, so what does strategic mean in that environment? If it was a B2B and the person could open up doors or make introductions and open up a B2B environment, that might be strategic. And so it might be a B2B and a B2C play. It could be just improving the product or improving the margins. It could be a whole bunch of other things. When I say the product, I'm not necessarily talking about the formulation, but maybe the packaging or whatever the case may be. So to me, the question of an investor is, what type of investor would you want, and how do you then value the business? Now, they would come in and they'd ask all these numbers as well, and you'd have to come to some sort of valuation. Two of you are going to think it's worth 2x. They're going to think it's worth X, because they're going to see the world differently if you can find each other. But the thing for me is, if you want to grow, that question around the GP percentage for me is the most important question. Is that if you're having that kind of growth, you should be getting economies of scale at some point. You should be at certain volume breaks starting to get better input costs, and your GP goes higher, or relatively speaking, your expenses are divided by over more units, and so your cost per unit goes down and your net profit goes up. I'm not hearing that in a strong enough way. So that tells me that there is room to play in terms of the GP margin, in terms of how you're thinking about that. But I think the biggest issue right now is a psychological relationship with debt. I think this is actually less of an economics or business story and more of a psychology story. So somewhere in your familial, yours or both of your familial backgrounds is this aversion to debt, right? And so that I mustn't owe anyone anything is a theme. But there's a whole other bunch of entrepreneurs out there who've got the opposite thing, where they say, OPM, other people's money. Don't use my money, use other people's money, because they don't mind having debt. And it might be some like me who's happy with a bit of both, about limiting what you have and what you owe and making your balance sheet more efficient. So to me, this is actually a psychological discussion and not a business discussion. It sounds like you've got a brilliant product. It sounds like you've got a market that's growing. It sounds like you've got quite a nice niche market. It sounds like you're passionate. It sounds like you've got the operations on hold. So this is your relationship now with debt. That's what it is. And if I were to advise you, which I'm just about to do, I would say to you, you need to change your relationship with debt. But there's a proviso here. If your margins are on the increase, If your margins are on the are the same, or in fact on decline, then I wouldn't have that relationship. So the fact that you work from home is problematic for me as a potential. I'm thinking from an outside perspective, because that means all your costs are not real, and it means, and I'm thinking with an investor's head in mind. If this business goes from 1,500 units to 15,000 units a month, then you can't do it from home. You can't work from the garage. That means you're going to pay real rent. But you spoke about the people in your business are people that were domestic workers, etc., that you've upskilled and upgraded. You're going to go into a market, into a labor market that's going to be a little less kind. Let me put it that way. And so your input costs will change. When your input costs change, there's now rent, there's insurance, there's all these other things that are probably being taken care of by the working from home environment. That's going to now take your net profit straight down. And so now you got debt because you grew, because you took on debt. Now you grew. Now your net margins have dropped, and you're saying, why the hell did I grow? I was making more money smaller than I did now that I'm bigger, because now I've got, let's call it, real world expenses. So that's why I keep coming back to the margin. If your real margins, I'm trying to find your real margin, your real expenses, what I would do is, the other thing we see a lot of mistakes with entrepreneurs is, are you earning market related salaries? Because the hypothetical model here is that if you had to hand this over to another MD who was earning a market related salary in that size business, would the business still make money? And if the answer is no, well, then the only thing that's happening is you're having a salary sacrifice and you're calling it net profit. That's all it is. Okay. So that's why I come back to this GP number. So I've got less than a minute left, so I'm going to just summarize here. Go and discover why you have this aversion to debt. Get to a point, in my opinion, where there's a healthy level of debt and there's an unhealthy level of debt. There's also an unhealthy level of no debt. Okay, it's both. There is a space where you have got the right amount of debt for the size of the business. Okay, where it's a healthy debt. The second thing is go to those GP margins, and my guess is that the price point is where you would also have to go. You'd have to nudge up the price point in order to make the higher margin. That's where I'd go. So that's all I've got to I've only had 8 minutes to talk about this. I hope I've given you some pointers to think about. And a big well done to both of you for coming out with a very interesting product and a first on the Big Small Business Show, Smell Mai Pits. That's it for today's show. Always remember, if you think it, write it down and make it a reality.
The Big Small Business Show, proudly sponsored by MTN Business.